Let's explore exercise 9-5B. It's a lower of cost or market valuation account problem, and I'll read it to you. Presented below is information related to Webby Incorporated. Okay, and now you can see in the table information to the left of my mouse, we had inventory at cost December 31st of $21,500, inventory determined at the lower of cost or market worth $20,000, and then we see the values change at various points in time. So that's the information we have, and we also see that we're given purchased information of $49,000, $43,000, and $51,000, as well as sales information, $71,000, $76,000, and $67,000. All right, instruction A says, from the information, prepare, as much as the data will permit, monthly income statements in column form for February, March, and April. The inventory is to be shown at the statement at cost, show the gain or loss due to market fluctuations, show that separately, and a valuation account is to be used for the difference between cost and the lower of cost or market. So let's tackle part A first. Alright, now you see the solution to part A, and all I've done is jotted in the information that was provided. They gave us $71,000, $76,000, and $67,000 of sales. They gave us beginning inventory of $21,500. Remember that? I'll flip back here and show you. $21,500. And once we have that $21,500, we have the purchase information that was already given, and we can compute the cost of goods available. So that's $70,500, $66,100, and $70,000 and $10. Then they gave us inventory, ending inventory, $23,000, $19,000, $10,000, and $12,000. That came from here, $23,000, $19,000, $10,000, and $24,000. So we can jot in the ending inventory, and from there we can compute cost of goods sold. Okay, so we've got the three cost of goods sold information right there. Okay, so with the information we can compute cost of goods sold, and if we can compute cost of goods sold, if we subtract that from sales, we can compute gross profit, and we do that for the 3 months. Then we've got to calculate the gain or loss due to market fluctuation of inventory, and where those values come from. There's the $1,000 loss, and then a $10 loss, and a $16.10 gain. That comes from right here. And how did we work that up? Well, we compare inventory at cost to inventory at lower of cost or market, and we determine the difference would be the allowance needed to reduce the inventory to market, and therefore we've got a gain or loss on market. And how we calculate that is we would take the allowance at the end of the period and compare it to the allowance at the beginning of the period for each period, right? And when you can do that, you can compute the gain or loss on the inventory amount. Now, keep those dollar amounts in mind. We had a $1,000 loss, a $10 loss, and $16.10 gain, and we'll move on to requirement 3. Actually, I meant to say requirement B. So with those dollar amounts, we see the entries. We've got a debit, loss due to market decline of inventory of $1,500 for at January 31st. And we credit the allowance to reduce inventory to market, right? That's our valuation allowance account. Then on February, we have an additional $1,000 loss, and the allowance gets built up. In March, it's just a $10 amount that's needed. And then in April, the loss gets reversed, right? So we call, rather than calling it a gain, we have a recovery of the loss due to market decline of inventory, and we have to debit the allowance to reduce inventory to market in the amount of $1,610. Now, if you have any questions on these, go back to the information appearing right here, provided in the problem. Pause this presentation whenever you need to so that you can go back and forth to see how the results were determined. Thanks, everybody.